Welcome back, everyone, to Sugar Mama's Fireplay, where we ignite your path to financial independence, early retirement, and generational wealth. I am your host, financial planner, Canna Campbell, and today we're talking with my own financial mentor, Mr. Peter Thornhill. He's an author, an educator, and a long-time advocate of Australian industrial shares as the foundation for growing passive income streams through dividends. Peter built, and go and check out all my other episodes, but Peter built a multi-million-dollar investment portfolio using a very simple dividend-focused portfolio of high-quality listed investment companies and industrial shares. And he's with us this morning to unpack why this sector still continues to deserve a cornerstone position in any FIRE strategy and plan. And he's going to weigh in on how this proposed ridiculous 30% tax on unrealised capital gains tax in super could really change things, or perhaps nothing at all. In fact, this may even make this strategy even stronger. So whether you're investing in your self-managed super fund or you are, like me, regularly investing in shares and LICs, this is the perfect episode for you and a must listen for your own wealth strategy as you head towards a long and luxurious retirement. So let's dive in. Good morning, Peter. How are you this morning?
I'm absolutely fine, in good shape.
Good, that's what I like to hear. Now, your signature investing style revolves around high-quality industrial Australian shares, predominantly through listed investment companies. In your own words, and I should say this is, I share the same investing philosophy, but in your own words, what makes this particular approach so powerful for people who are part of the FIRE lifestyle movement, that is financial independence, retire early?
I guess certainly for Frida and I, neither of us had much money at all when we were young. We both worked hard, and Frida raised 3 beautiful sons for me. I continued working, and the end result is that in, quote, retirement, we're working harder, playing.
Enjoying all that money.
Enjoying life like we could never have imagined in our wildest dreams.
Can you just quickly name the countries that you have visited in the last 12 months, quickly for my listeners, to get an idea of how much fun you're really having?
Well, a couple of weeks ago, we were in France and spent a couple of days in Paris, then cruised from Paris to Normandy, then from Normandy, and then back to Paris, and then from there we went to Bruges, Ghent, and then to Rotterdam, and then from Rotterdam we went to London, or to England, and had a week there hooking up with family and friends, and then flew home.
And before that trip, Morocco, I believe?
Morocco. We went to Portugal. We've been to Portugal. We're looking now at where else we can spread our wings, although it is becoming very crowded out there.
So life's pretty boring and dull.
Well, no, on the contrary. But for us now, we're so fortunate to have achieved what we have over the years. And at this point, I can honestly say we are doing what we love the most, often while we are still on the planet.
Now, in your book, my Motivated Money, I say Mindful Money, Motivated Money, which is my favorite financial book. I've stopped lending it to people because I never get it back. But you have some really powerful charts in there showing the return of $1,000 or $10,000 or $100,000. And you show the difference between resources and industrials and the All Ords. And there is a profound difference between the industrial index and the resources index, and even the All Ords. Can you, over a long period of time, can you explain how these returns are so profoundly different?
It's very simple. We dig stuff out of the ground. And unfortunately, we then send it off to other countries who then manufacture valuable goods. And I think the best example I've got is we sell iron ore at about $260 a tonne or something like that. And we send that overseas, sell it. The people who get it then add value to it, and they return it in the form of automobiles at $20,000 a tonne. So we export at $260 and we re-import at $20,000. Now, we used to make cars once.
Yeah.
There was a Ford factory in Melbourne. There was Fisherman's Bend, there was a General Motors. We make very little of anything now. We export the raw materials. They then add value, and we pay monstrous amounts of money. But it goes beyond that, Canna. And we are not particularly happy with shares in this country, and it's very noticeable. The Register of Pecuniary Interests for the Federal Parliament, I think, speaks volumes.
Yeah.
The majority of the Federal Parliament of this country, when I got the register a year or 2 or 3 years ago, they're all up to their eyeballs in negatively geared property. Not a lot of them own shares.
Yeah. And
the consequence of that attitude, which spreads throughout the population, negative gearing is apparently the hot thing. You've got to lose money to really make a lot. And the consequences are that most of Australian companies are owned by overseas investors. I think it was BHP is about 72% owned overseas. Rio is about 68% or something. So if you run through the register of most of Australia's leading companies, they're all owned by overseas investors. The consequence of that, in my dividend realm, about $40 billion in dividends disappear out of this country every year.
It almost feels like just completely embarrassingly stupid that we've let it get to this stage.
It is. And it just devastates me to see all this capital disappearing overseas, and we're sitting here playing with property, and it's just utter madness. But Australia's paying the price for it all, because if you look at the accounts and blah, 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 associated with it, Australia is not a particularly wealthy country.
We're all a slave to our egos. Now, you're a strong advocate of benign neglect. How does that play out from a practical point of view in a portfolio like your portfolio that is like predominantly, invested in industrial shares and obviously listed investment companies now as your main, investment product, so to say? Just simple buy and hold and go travelling.
And go travelling on the dividends, yeah. And I have been rationalising quite a bit now, and with the stupidity associated with possible taxation on capital gains.
Yes, I'm dying to hear about your thoughts on this in a second.
But it doesn't surprise me, because the Australian Federal Parliament is full of Australians. And as I joke with audiences, when I'm Prime Minister, I'm not going to have one Australian in my cabinet. I'm going to go overseas and hand-pick my cabinet. So,
during times like this, when the stock market is considered to be volatile and, irrational and emotional, and I don't believe the stock market is irrational or emotional, because it's not a person with feelings, but how do you exercise that self-control where you don't get tempted to check your portfolio and make an irrational knee-jerk reaction, or perhaps you do check it and don't care, or you do check it because you get excited you're going to invest more if you've got some spare cash? Like, I feel like at the moment a lot of people are letting their emotions run wild, and for some, they're having these knee-jerk reactions where they're, for example, selling, because they're seeing these headlines. Like, how do you exercise, I guess that almost like burying your head in the sand to a certain degree, as I said, when I say, this benign neglect? Like, how do you just rise above all the noise?
Now, after all these years, it's very, very easy. I have no interest at all. And the fact that new share prices are quoted every minute of the day, 5 days a week, and people sit in front of computer, whatever, read all the finance magazines, etc., etc. I've got better things to do. I have no interest in what is going on a daily basis. And the fact that the share market is volatile is a clear indication, because the share market itself doesn't go up or down. The share market is pushed and pulled up and down by people who are reacting to any lunatic event that occurs.
Which is then only fueled even further by the media, in my opinion.
Correct. The media just love it. They love it.
Clickbait.
And of course, that stirs the public. And so when I'm Prime Minister, the share market's going to be valued once a year.
I do wonder how many people make an investment decision on a headline rather than actually reading the entire story.
That would be, part and parcel. But for most people, it's looking at what the shares are doing every day of the week. And for many people, the share market went down today, we'll go and buy some. Oh, God, the share market's gone up, we'll take some profits. So we are causing the share market to go up and down, and yet people blame the share market for their poor investment performance. Well, if you stopped fiddling with the bloody thing, it would be okay.
So on that note then, how often do you check your investment portfolio?
Oh, I don't know, maybe Christmas.
Once a year? Or tax time, probably.
To be honest, as I said, Frida and I have got better things to do.
And it sounds like you've got a lot of time as well, which is such a luxury.
Well, for us it is, because all the, work and stuff, and I'm presenting less and less, so I've got more and more free time. And so we're just spreading our wings and having as much fun as we possibly can.
And so you should.
Damn right. While we're here now, we are enjoying the benefits of a relationship that was accidentally perfect. I married a saver.
And you're an investor.
And I'm an investor.
For the people who are part of the FIRE lifestyle of, regularly investing and obviously saving as well, and obviously paying down debt, they're on that path where they are really trying to do things differently that their parents may have done, or really try and build something for themselves or for their loved ones. What would you say to those people who constantly get fixated on building their financial goals around the capital value of their wealth versus the income value of their wealth?
Because the capital value is a big number. The dividends, in terms of shares, are quite small compared to the individual share price. And so your share portfolio, the price is more attractive.
Gives you that dopamine hit.
Yeah. And share prices are quoted daily. Dividends, you get 2 a year, or if you're lucky, 4 a year. For a company that pays quarterly dividends, unfortunately there are not many of them in Australia. And it's very noticeable to me, because I left my super fund in England when Frida and I returned to Australia, and I have 4 listed investment companies. So we've been in there for 20, 30 years. Every one of those 4 pays quarterly dividends. We get 16 dividend checks a year, and it's in our super fund in England, so we then get paid a lovely monthly
income stream. And that's the thing, is the end of the day, the value of that portfolio is superfluous. It has no importance really if you're trying to build freedom. The freedom comes from the income, that passive income where your money is working for you. Correct. Because that is going to replace your full-time job, or allow you to drop down to part-time work. That's where the true freedom comes. And you're right, it's that ego. We just get sucked into this sexy number that's this high number, and forget to pay attention to what's really important, which is that income. what are we earning? What is our money actually making us and creating us every single year?
The three things one should focus on absolutely in one's life is family, friends, and career. Forget everything else. They are your primary foci. And you just do everything you possibly can to make that your arrangements with all of that the best you possibly can.
I was listening to a podcast. It was actually something Tom sent me the other day, and it was talking about, juggling balls and how we focus on money in our career. And if we're juggling too much, we're obviously going to drop a ball. And the thing with, the most important balls are our family and our health, because you drop a career ball, it bounces, it can bounce back, you can catch up. But you drop a family ball or a health ball, you damage it or it shatters and you can't put it back together again. We've got to remind ourselves of that as we, work so hard, and we sometimes work so hard that we back ourselves into a corner and become a slave to our situation and the lifestyle creep. So, I completely agree with that. And sometimes it's not until something bad happens in life that you kind of get that wake up call or that, adjustment where you maybe lose someone or have a health scare or, something happens of significance in your life to get that moment of reflection and insight as to what really matters. But we don't have to let something bad happen to us. We can wake up today and realize what really is important and take a slow and steady pace to build wealth and to build freedom for ourselves, living a life with intention and attention.
And certainly at this stage in life, Frida and I are enjoying as much as possible connection with friends and family. And
enjoying the health that you have as well.
And we are very fortunate that both of us, actually, I'm 78, and in a couple of months, Frida will be 78 as well. But we're having as much fun now. In fact, we're having more fun now because we have so much free time, and we now have grandchildren that we're connecting with.
Yeah.
And I've got 5 gorgeous granddaughters. Do you think we can have a good party with them?
I bet. Those granddaughters of yours are very, very lucky. Now, I'm actually I've written my third book, Financial Freedom, and based around investing in Australian industrial shares. And whenever people ask me, like, why are you so passionate about shares? And it's not just shares, it's just industrial shares, because as I mentioned, that amazing chart in your book, between resources and the All Ords and then, of course, industrials. Can you explain to our listeners right now the importance of growing dividends? Because a lot of people don't grasp the concept of that over the long run. And maybe can we almost compare it against how that looks in, say, comparison to, say, an investment property?
We own listed investment companies, and I have trimmed back over the last 20-odd years the individual shareholdings because, to be honest, I don't want all of that. And we're focused much more on the listed investment companies where all the hard work and all the examinations and the accounting, etc., is all handled by someone else on our behalf, which leaves us with the free time that we enjoy.
Not that this is ever investment advice or product advice. And again, a reminder to everyone about my general advice warning, which is obviously always disclosed in the podcast notes. But, what are, say, the top 3 most popular listed investment companies in Australia?
The ones that have been around the longest time. So you've probably got AFIC, Argo, Whitefield, Brickworks is another one. I love to pieces. Yeah. And again, it's the fact that Frida and I buzzed off shortly after we got married on an 18-month working holiday and didn't come home for 18 years was pure gold.
Yeah.
Living in England, I learnt so much.
Well, the great thing is you've written everything you've learnt, you've put down in your book, Motivated Money, which is absolutely brilliant. And it's interesting, whenever I recommend it to people, and as I said, I don't lend my copy out anymore because I never get it back, people always come back to me and say, oh my goodness, this is absolutely gold. Why didn't I read this years ago? And they absolutely love it. And it does have a profound impact in the way people rethink property and rethink their wealth strategy and what they're really doing to create a meaningful life where they have, be able to create something you and Frida have created with this immense freedom, this time, this choice, the flexibility that you have is just, it's people dream of what you've created, but it's actually realistic for everybody.
It has impressed upon me the sickness in terms of the way the brains here in Australia all focus very heavily on property. And on the odd occasion, if I push it a little bit, I ask people, how much does it cost you to own the property? Oh, this and this. Yeah. Oh, have you had to do any repairs? Oh yeah, that. What rates do you pay? What insurance on the property do you pay? And I said, I asked, do you ever include that in your calculation of what the thing is worth? Oh, no, because the negatively geared property is simply there on the basis of being sold for a lump sum at some stage. The income stream is not that great.
Well, this is the thing. When you ask those questions, I love to ask. I do the same thing, about, well, hang on, what's the cost or the true cost? Like, people love to just gloss over, well, it's gone up in value by 300,000. They just sort of stop at that. But then when you pick holes and you sort of the smile the gloat starts to disintegrate in front of you. But then you ask them about the income. You're like, well, has that rental income increased each year? And they might go, well, I've put the rent up, in alignment with the market, for example. But then you think, hang on, you had it empty for 6 weeks and you had to pay all these expenses in the meantime. What was your actual net rental at the end of each financial year? And how does that compare with the year before that and the year before that and the year before that? And you'll see that you don't have that consistency in growing rentals income streams like you do with Australian industrial shares. There's on the Whitefield website, it actually says, I think their dividend has increased on average 5% each year.
Yeah, it frustrates the living daylights out of me. And, if I ever get into a conversation, I try to calm down. But my questions are, so what are the annual costs of this property?
Yeah.
Oh, well, we haven't added them up. I said, oh, okay. And I said, and the rent you receive, does it come with a tax credit?
Well, all right. We've got to move on to this. Obviously, this very heated topic at the moment of the proposed taxing of unrealised capital gains tax within super for account balances over $3 million. What are your thoughts and feelings about this, if it is passed through Senate?
I think it's a disgrace and a disaster, because the more you can encourage people to create their superannuation fund, it makes less demands on the public purse in terms of, government funding for retirees. But, it's crazy, and the misguided parliament and whatever, it just knocks my socks off.
I mean, it's deplorable. I don't even understand how it's managed to get this far already. Like, I'm in shock, and I think the damage it's going to do to our economy, to the system that, superannuation, I think, was initially established in the 70s, maybe BHP, and then officially kicked off in the early 90s. It has taken so long for people to actually trust superannuation and realise actually it is such a powerful tool in allowing people to become investors, allowing people to understand how money works and give them the opportunity to be able to create a sense of financial freedom themselves, and they're just going to basically stuff it up. It's just in one simple decision.
And
ruin by one, ruin for all.
Yeah, and the madness is that the media tends to look upon it as, all those really wealthy people. What they fail to remind everyone of is Do you know how much those really wealthy people spend in Australia? Do you know how much they plough into the economy of this country?
Yeah.
And I, speaking from my own spot, if you like, adding hundreds of thousands of dollars to the cash flow, the income that is spent in this country to satisfy businesses, etc., etc. But it's all this misguided, this is cheating, they're too rich and blah, blah, blah.
Well, this is the thing. They hide behind it, being a Robin Hood tax, like protecting the poor, I guess rebalancing the sheet, I think is the saying. But it's actually not a rich man's problem. It's everybody's problem, because that $3 million figure is not indexed either.
No.
And if you think about it, like SG contributions are 12%. So it is more and more people every single year will actually quickly approach that threshold of $3 million. And, as people become more and more financially literate, they're making great decisions with their money. They're seeing their returns, they're seeing dividend reinvestment, they're seeing the growth of those dividends, and they're making smart decisions with that money. More and more people are going to be impacted by this. And there was an economist, I think at AMP, by the surname Musina, who actually did some research, and even people who are 22 years old are going to be impacted by this ridiculous tax, unrealized capital gains tax, as they approach retirement. The damage is huge. But from you, like you've shared your portfolio, last time you shared it was a couple of years ago, I think it was $10 million. And, you're drawing this incredible growing passive income stream of over $400,000 a year. So I'm going to assume that you're going to be one of these people that is rich people that have been hit by this tax. From a strategic point of view, what are you going to do? Are you going to, if it gets passed, are you going to just...
What have I already done?
Well, okay, all right. This is the question I needed to ask earlier then.
Okay, I've gutted my super fund.
Really?
Yep. And I now have a company that has received all the proceeds coming out. And that company, Frida and I are the two directors, and it invests in shares. And so as directors of a company, we draw our income.
Through your dividends.
And we now have a trust separately. So all these are being funded. Super has come way down.
Yeah.
Well below the limits, but it's now sitting in another environment. And so the income stream we're still enjoying, we're still getting the franking credits, and life rolls on. But I don't understand. I do understand.
You beat them at their own game. You're like 10 steps ahead of the government.
But it's crazy, and this is where I could weep sometimes, can I, honestly, the sheer stupidity of the politicians in this country. I could cry.
Well, I could cry with you, because it's so disheartening when someone like myself. I'm so passionate about making people take their financial well-being seriously, make smart, intelligent decisions, have no regrets, learning to make a few sacrifices along the way, and have that self-control and discipline to stay the course. Yep. And to keep their eye on their passive income streams through dividends. To have this happen is such a slap in the face. And, you could sort of throw the towel in with super, and I wouldn't blame people for, giving up complete hope. And obviously you're in a very different situation in that you're 78. You have that access, and you've had professional advice, obviously strategic advice around this shift, and you've been able to obviously move that money, tax-free, I'm going to assume. So you are incredibly lucky, and that's the value of having a great advisor, being very informed, but also proactive advice. Not this knee-jerk reaction to changes in laws and legislation and caps and contributions, things like that. The combination of proactive advice and making great decisions with your money. And I'm really glad to hear that you are not going to be victim to this ridiculous law if it does come.
And, I just hope that other people will be in the position. of getting appropriate advice to do exactly the same thing. Let's beat the government at its own game.
Yeah. And I am sure that people who've already built that level of wealth have already done exactly as you've done. So, I mean, it's probably going to be even a smaller percentage of people that, do have to face this, but we're still going to be left, the people with less than $3 million who do approach that, we're going to be obviously be the ones that bear the consequences of this.
Sadly, financial education is not part of the curriculum in this country.
Yeah. Well, hopefully I can change that.
I'm with you.
Oh, thank you. Well, look, Peter, thank you so much for your time today. For anyone who's interested in learning more about shares and investing in shares and the power of Australian industrial shares, can I highly recommend that you go and grab a copy of Peter's book, Motivated Money. He's sold how many thousands of copies?
It's about 70,000, and it's not in any bookshops.
It's on Amazon. I will go and link it in the podcast notes for everyone. And obviously you can buy it directly from Peter through his website. But it is by far one of the best and most brilliant books if you want financial independence and you want to retire early and you want to retire rich and you want to go on as many holidays as Peter and his beautiful wife Frida go on. I cannot recommend it myself. And, I'm very open in sharing this. My investment philosophy is paying off my mortgage, but also debt recycling and investing in listed investment companies. And more, as I realize myself, time poor, juggling children and work and all the other chaos of life. I'm time poor. I don't want to sit there picking individual stocks. For me, I'm on the same boat as you. Listed investment companies are my preferred investment vehicle for creating that passive income stream and achieving that financial goal. And
the comfort I mentioned earlier was City of London, a listed investment company in England. It's only been going for 163 years.
Oh, only.
And as I said, it's just paid its 57th dividend increase.
And that's that key word, dividend increase. Are your rents, your net rents, increasing year after year? That's what I want to ask people who really question where property sits in their portfolio and perhaps do a little bit of research and comparison. All right, everyone, thank you so much for listening to Sugar Mama's Fireplay. I look forward to chatting with you next Monday morning at 5 a.m. Ciao for now.